For our next panel, we will be talking about ETFs, its current state, and where it's going. For that, I've got two very esteemed panelists. My first one is Nerina Visser. She is a director and strategist at etfSA. She is also a financial advisor, and I think if you don't know Nerina by now, you're not involved in the financial markets in South Africa. So thank you very much, Nerina. Then also my second panelist is Deborah Fuhr. She is the founder and managing director of ETFGI. She has got a long history in ETFs, and I want to say it's probably one of the most respected people in the ETF market globally. So, Deborah, thank you very much for joining us. Deborah's joined us via Teams. She's busy. She's in high demand, so we really appreciate your time and that. Morning, Deborah. Can you hear us?
Yes, good morning. It's great to be joining you. I wish I was there in person, but glad to be there virtually.
I think for our next, as I said, for our next topic, we are going to talk about ETFs. I know it's very often in the media, and everybody's got a lot to say, and the great debate about passive and active management, but that's not what we're going to talk about here today. With my two panelists, I'm going to pose a couple of questions to them, and for first of those is I think it's probably a very good point to kick off, to ask first Deborah and then Nerina of where do we find ourselves in the ETF market? What is currently happening in the international market first? If Deborah can please expand to us what you're seeing, what's happening in Europe as well as in America, where we know those are the two largest markets currently.
Yeah, so maybe just to add a little perspective. So I've been doing research on the ETF industry for just over 25 years. So when I started, there were 21 ETFs and $8 billion invested in them. Today, globally, there are now 11,164 products with nearly 23,000 listings. We have $9.88 trillion invested globally. There's 678 providers. They're listed on 81 exchanges in 63 countries. So when we think about the ETF industry, the first ETF was listed in Canada, and it's celebrating its 33rd birthday on March 9th. The US just celebrated in January the 30th anniversary, and Europe will celebrate the 23rd anniversary in April. So when I think about the ETF industry, one of the things that really made it appealing to me is it is the only democratic investment product out there. And by that, I mean, we see ETFs being used by pension funds, asset managers, hedge funds, insurance companies, and also financial advisors, and then retail. And they use the exact same products with the same small minimum investment size and a very cost-efficient annual cost. And that has allowed investors to really think about asset allocation and savings in a way that wasn't available to them before the ETF, because usually retail would have a small toolbox and high fees, and institutions would have a big toolbox and low fees. So when I think about what's going on, what we are seeing is that during COVID, many people, because they were forced to stay at home, started to look at their finances and how to save. And many went to robos and became informed about how to think about saving. And most robos have ETFs inside of them. So they learned the benefit of asset allocation. They learned the benefit of over the long run investing in lower cost products gives you better returns. And they also learned about ETFs in general. And what we also saw was during the COVID period, there were many new investors entering the market. So in the US, there were 15% of investors trading in the market in 2021 were new. There were 1 million new investors in Canada. It's hard to get data in every other jurisdiction because I don't think people ask, but I would say people sitting at home did look at investing. And I think that many learned that ETFs are a useful tool. We've had 44 months of consecutive net inflows. And so An ETF is, in essence, a mutual fund with the added benefit of being listed and traded on exchanges. And so that means you can get in or out whenever you want to. You can get exposure to equity, fixed income, and commodities. And, we do now also have active ETFs. And I know Nerina is going to speak about some of the evolution happening in South Africa specifically. But, it's just another way to get exposure. And I think it adds a lot of benefit. So people are using them to one-off, get exposure to a theme, get exposure to international markets. There's many ways they're being used. And I think the interesting thing is, although we're celebrating 33 years, in many ways, ETFs are still acting like a child where people are discovering them for the first time and discovering new ways to use them. And so I would say the challenge for most people is until they try, they're not really sure about ETFs. But once they try, they use ETFs in more ways and in larger sizes. So it's really getting people to make that first attempt to use them in some way that you find they really do become a tool to help you do your job.
Sure, that's a lot of information, but what always catches me is the astounding growth, and just correct me, was it 44 months of net positive flows? That is
Correct.
I think that's something to say. Nerina, your side, what are we seeing in the local market happening?
It is most definitely an industry of evolution. And I think I can almost define the evolution of exchange traded products through 4 phases. The very first phase Deborah referred to, when the first one was listed in Canada, in the US, even in South Africa, where our first ETF was listed in the year 2000, so celebrating its 23rd birthday this year. That very first evolution of this was all about vanilla basic index tracking, broad-based market access. Your top 40, your FTSE 100, your S&P 500, very simple, easy to understand access to a basket of broadly diversified equities. The second evolution was really to say, but that same principle of broad-based asset class exposure can also be applied to other asset classes. So we saw the evolution going from equities only to bonds, to listed property, even to commodities. So the access to different asset classes suddenly started open up the opportunity for multi-asset portfolios, asset allocation decisions being implemented using ETFs. The third evolution for me really was all about moving away from traditional, what I would almost call vanilla indexation, which is market cap weighted, because there's a lot of valid criticism around the fallacy of market cap weighted indices. And I think especially in South Africa, we're very, very aware of the problems associated with almost pure, blind, unintelligent market cap weighting, whereas we know that the drivers of performance in investments go much beyond size. So we saw the rise in the introduction of so-called smart beta or factor beta or strategy beta. So this is where you were looking at factors such as maybe dividend strategies or momentum or value or any number of these, and really sort of moving away from the idea of only using size or market cap as the basis for your indexation. But we are currently in the fourth wave, the fourth evolution in terms of this, and this is about the introduction of actively managed strategies inside exchange-traded funds, inside exchange-traded products. And it's a very exciting phase, and it's really sort of starting to blur this line between what was in ancient times, I'm going to say, known as the active versus passive. You realize now that actually it's become one big blurry area. But there's one golden thread that runs throughout this entire evolution of exchange-traded products, and it sits in that ET bit of the name, exchange-traded. It's about the access point. It's about where do I actually buy these investments. Most of you and most of our industry operates on the basis of what is effectively OTC product, over the counter. If you are investing in unit trusts or you are investing into pension fund investments, those are OTC. Whereas an exchange-traded product brings that exact same product to a listing on the stock exchange, which brings with it a whole host of additional benefits, especially to the client, but certainly also to the whole administrative process. So we really once and for all need to break this link between thinking that when we hear ETF, we're just talking about a boring old top 40 or S&P 500 index. This is about an access point, and I love the point that Deborah raised in terms of the democratization. The fact that this really is an investment instrument that allows equal treatment of any and every and all investors. And the simple reason for that is that you cannot have multiple fee classes in an exchange-traded product, because it trades right throughout the trading day at one price for everybody that trades at that time. So you can't accommodate multiple fee classes. And that's really where the democratization comes in. And I think in a country like South Africa, we're so aware of how important this is to really open up financial inclusion and to give access to investment opportunities for all and any investors. And probably one of the main reasons why I'm so passionate about the instrument, the exchange-traded product instrument. What the underlying is, how we manage it, whether it's active or not, whether it's a bond, whether it's a commodity, those are details. I want us to understand that as long as we are also managing our client assets through traditional LISP platforms that don't provide ready access to exchange-traded products, we are necessarily excluded from a massive opportunity set in terms of how we can better service our clients. And I'm going to leave it at that.
Yeah, thank you. I think for me, there's one comment and one thought. And the one comment is both my colleagues here, is everybody is equal in ETFs. Mm-hmm. i.e. there's no institutions, individuals, no one gets better or worse pricing. Everybody gets the same pricing. And I think that's one of the really big draw cards. And at 1nvest, we see it as well. We've got what I call do-it-yourself investors. They log on to online broker platforms. They want to play around and do their own investing. They do it through TFSI accounts. Then we've got a lot of IFAs, advisors like yourself, helping their clients manage their portfolios. And for that, they take that advice fee. And I think, and a previous panel touched on this, people still want to talk to people and because financial decisions are important. They will play around, get information, but before they push that button, they want to talk to someone, and that's a comfort, and they're willing to pay for it. Then we also have DFMs as well as large institutional investors in our ETFs. And that's also the multi-use in an ETF. It's not just a long-only investment. And here's the comment of mine. Everybody says, yeah, ETFs aren't buy and hold, traditional. Yes, you can do that. They're long-term investment. But they are also strategic trading instruments, allocation asset instruments. And there's a financial advisor is a key role in that to help your clients move between geographies, asset classes, and that. So it's not just buying an ETF, putting it in the back pocket and forgetting about it. It's actively managing that ETF portfolio that is key. So, Deborah, in South Africa, there's our index tracking or industry is going quite quickly. Similar, we're seeing this total J curve at this stage. In South Africa, there's quite a hot debate between unit trust, index tracking unit trusts, or internationally it will be mutual funds, and ETFs. Please, what is happening internationally, and are you also seeing a divergence there, or is most of this going into the ETFs? Where is it going?
You know, that's a great question. And what we are seeing is many investors are preferring ETFs over mutual funds. So if you look at mutual funds in terms of consistent consecutive net inflows, you definitely do not see 44 months of consecutive net inflows. There's been many months where mutual funds have suffered outflows. What we're seeing in the US, which I think really resonates globally, is that most asset managers who have products are seeing demand from their end clients to convert or launch ETFs. And so a trend that started about 2 years ago in the US is that many of the large asset managers are converting existing mutual funds into ETFs. So we've seen Dimensional Fund Advisors, Capital Group, T. Rowe Price, Putnam. I mean, the list is pretty long. There's like 20 firms. So I think today, when you look at asset managers, they're all thinking ETFs are just another wrapper that they want to and should be able to offer to their clients. So I really believe it's just a question of time when we see really all of the large asset managers have an ETF offering. I mean, recently, actually, Morgan Stanley just entered the ETF industry, someplace I worked for 11 years. We had expected to launch ETFs back in 2000. I think if we had back then, we probably would have been the biggest asset manager in Europe for ETFs, but it's kind of water under the bridge at this point. So I do think that ETFs are really growing. And as Nerina said, right now, it's not a debate about active or passive. And I would say many people think about ETFs, if they are tracking an index, as index products. And most investors are approaching things in a barbell approach. So where they can find alpha, they do it, whether it's security selection, ETFs that are active, or mutual funds. But where they can't, they often use index products to generate alpha through asset allocation. So overweighting countries, underweighting countries, sectors, or changing asset classes. And as you said, sometimes that's tactical and sometimes it is longer term. So I do believe that ETFs really are in a significant phase of that upward slope because we are seeing many asset managers finally embrace them after they've been out there for 33 years.
Yeah, thank you, Deborah. It's interesting. Nerina, what are we seeing in the local market here?
So some of those similar trends that Deborah has been referring to, but I think there's one distinct difference in terms of what we see in South Africa and should expect to see that is not going to replicate what's happening in the US. For starters, one of the main reasons why the ETF industry, in particular in the US, has been so successful is that it actually offers tax advantages that the mutual fund in the US does not offer. In South Africa, our unit trusts and our CIS ETFs have got exactly the same tax advantages. So there's not that same underlying drive to actually get into ETFs rather than mutual funds or unit trusts because we don't have separate or better tax advantages. The other very important aspect is that we do now have the introduction of actively managed ETFs on the JSE, but the etfSA has specifically said that we cannot convert existing unit trusts into ETFs. Now that's a trend that we saw very strongly taking root in the US. We're not going to see that in South Africa. The etfSA is still going to require that it will be a separate physical fund or portfolio that underlies an ETF. So even if you've got exactly the same strategy in your unit trust that you now want to list as an ETF, it's going to have to be two separate funds, which I think is unfortunate because I think it's necessarily going to inhibit the extent of the conversion into ETFs. But what we definitely have, and I want you to think if we now focus on the exchange-traded product category of this, is that we're now starting to see a clear, almost matrix in terms of different options. The first differentiation sits behind what the underlying asset type is. Is it a physically backed fund, which belongs to the investors, or is it a bank-issued note or a credit instrument? What I mean with that is a CIS or an ETF, an exchange-traded fund. The underlying is a CIS, or it's a ring-fenced asset that belongs to the investor. So that's sort of one aspect of it. The other one where we've seen significant growth in recent times is in your what was just first exchange-traded notes. So these are bank-issued instruments, and the majority of these were also index tracking products. But we now also have in the second dimension, so if you think fund versus note, in the other dimension, you've then got index tracking versus actively managed. And so you've got both of those in both product types. We've seen a very strong rise in so-called actively managed certificates. That's been the first wave of actively managed exchange-traded products that we've got in South Africa, and Standard Bank themselves are one of the big issuers of these actively managed certificates. But we also have the listing requirements in place now for actively managed ETFs. So we should expect a rise in terms of, think of this as the quadrant of 4 different product types. So what's quite important is that you see asset managers coming more and more to the table saying, I'm agnostic as far as the wrapper type is concerned. I don't really care whether you invest in my fund using a unit trust or an ETF or a note or a managed certificate or whatever. I need to be able to offer multiple wrapper types in order to access a broader investor range. And very interesting for me in this space is especially your mid-sized boutique asset managers who are very interested in the actively managed ETF space because they see a whole new distribution channel of access to client money and to investors via the listed entity, via the personal stock broker model. So as an IFA who primarily focuses on list platforms and unlisted investments, you are necessarily missing out on that client flow that comes through stockbrokers and through stockbroking portfolios. So I think there's a very interesting sort of level of evolution that is taking place in terms of this and around the product wrapper types in particular. Clearly there are advantages and disadvantages to all of these. So as an advisor also, it's going to be very important that you understand what the pros and the cons of each of those are, especially when it comes to things like the tax implications, the credit risk associated with a note versus a fund, for example. And I love the type of comments that was made in the previous panel around what are some of those important human aspects that you really need to understand well and to understand how that best matches your client in terms of their particular tax position or their liquidity requirements that they might have or whatever the case might be. The underlying product or investment strategy is just one question. Which wrapper and which conduit or access point I'm going to use is a separate decision all on its own.
Yeah, thanks, Nerina. And I think the one question there pertinent, and I think particularly for our audience, Deborah, what are the advisors internationally using, or how are they accessing these products currently?
Yeah, that's a great question. I think some of them are using ETFs kind of one-off. So often what they'll do, well, in South Africa, you have Nerina and her company helping you figure out what products are out there. So that's kind of a useful tool. But in general, the media is quite active in talking about ETFs in the US. So if you were to watch CNBC in the US, anytime they talk about what's happening, they're talking about ETFs with tickers for countries, for sectors, for themes. And so I think people see that, their clients listen to that, the advisors hear that. But what we are seeing as a major trend in the US and slowly coming to Europe is many of the advisors and banks and brokers and platforms are creating what we would call model portfolios. And so basically they're creating portfolios that could be balanced, they could be tactical asset allocation, sector rotation, even produced by some professors. And so you can invest in a portfolio that underlying it is a basket of ETFs. And so for many advisors, as the job of being an advisor becomes more challenging, your clients want you to be able to help them with tax, and they want you to know both the husband and wife are partners in the relationship and the children. You need to do a lot more. And so you're finding that many advisors will use a model portfolio to be able to manage the asset allocation for their clients. So I think model portfolios is a big trend. I think online platforms are becoming more important. We even saw here in the UK, Hargreaves have just launched 3 model portfolios the first time, and they're using a combination of mutual funds and ETFs. So as Nerina said, sometimes you might use mutual funds, sometimes you might use ETFs. So I think sometimes it's directly going and looking at ETFs as a one-off sleeve, a core, a satellite, tactical allocation. Other times it can be the entire portfolio.
Yeah, thanks, Deborah. Nerina, in our local market, what are we seeing? How are advisors accessing and using? And very much to Deborah's point as well, model portfolios, does it exist? What are we seeing happening locally?
Yes, there are some model portfolios, but I think it's in the infant stage. I think it's really relatively early days, but I would expect that to grow over time as well. What we are seeing a lot of is that because of the transparency of exchange-traded products and because of the consistency with which an index or a rules basis determines the underlying investments, it gives a very strong tool for an advisor to identify specific products that suits client objectives. So we're finding a lot of focus in terms of, I'm looking for a specific solution to my client's problem. That might be a completion strategy to actually get exposure to a specific region or to a specific industry globally. Or it might be about a specific income requirement that a client might have, or whatever your client objective is. It's often a lot easier to translate that into an exchange-traded product or a couple of exchange-traded products that actually solve for that client objective. We also see that in terms of indexation, index-based products, rules-based products, there's a much bigger range of strategies available in ETF or exchange-traded product form than they are in unit trust form. Your index tracking unit trusts are very vanilla, very bland, quite a lot of strong, big multi-asset portfolios, which I guess is to some extent almost a bit like a model portfolio. So there's a big space there. But other than that, there's very little differentiated strategies, index-based strategies in unit trust form. But when you go to the ETF space, I mean, we have over 180 exchange-traded products listed on the JSE. That's a lot more than the number of investable companies that you've got on the JSE. Yes, it's not quite there. I don't even know if I've lost track of the number of unit trusts we have in this country, but it's still not there. But the fact is that you've got a vast range of types of strategies. And so, for example, focusing on things like dividend-paying strategies, something which might be very important in your client requirements, or getting exposure to particular global markets or to regions. You know, a very strong theme prior to 2022 was thematic investments. And unfortunately, we found that a lot of the thematic investments also ended up being in a lot of your growth industries. So it was tech, it was about sort of biotechnology and healthcare and those sort of things, which certainly was not the flavor of the month in 2022. But the point is that you have the ability to actually access such very targeted exposures through a rules-based or an index-based product in an ETF, something which is extremely difficult to come by in the unit trust space.
No, thank you. And I think it reiterates my point, what you're trying to say. There is a responsibility to manage this portfolio.
Absolutely.
And yes, give the right advice, target it what you want, but manage this portfolio. Deborah, any final thoughts on that before we finish off?
I guess, having been in the industry for a long time, if you're afraid to do ETFs and you're afraid to ask questions, never assume. There's never a bad question. I think there's a lot of us who've been involved in the industry, and Nerina is one of the people who I would say is always willing and able to help. So if you're not sure, just ask. Johan also has been involved with the industry for a long time. So we always want to see people understand what they're doing and do it properly. And I think asking the questions is the best advice we can probably share with anyone.
Thank you very much. Nerina, final thoughts?
I think as an advisor, it's incredibly important to upskill yourself in this space and to understand what should be the basis for selecting a particular index-based product or an ETF, or even for that matter then an actively managed certificate, and I guess even for selecting a specific unit trust for your client. The skill set that is required in order to do this is something that might not come naturally to you. The way that you assessed investment opportunities in the past might be quite different in the index-based world. So I really encourage you, and yes, absolutely, educate yourself. It's one of the great things about these products is that they are so transparent. Please don't look at past performance. Not because past performance has been bad, but because it really is no indication of future performance. I want to encourage you to look at the investment objective, the index objective. How is that index constructed? What is the starting universe? What is the selection criteria? What is the basis on which it is then weighted or added into the portfolio? Those are really the key indicators that's going to give you some sort of idea of what performance I should expect expect in future from this, and how to best match that back to my client investment objectives. It's a great opportunity as an advisor, I think, to really sort of prove your value by being able to match client needs and client outcome requirements to specific targeted investment exposures that actually solve the client needs. So,
no, thank you very much. And I think there's a lot of valuable information that was shared here. And the one comment that just sprung to mind while you were talking, Nerina, is the one question that always comes up on the ETF and say, yeah, but it's small or it's not liquid in that. By all means, an ETF takes its liquidity from the sum of its underlying components, because that's what you're buying at the end of the day.
Yep.
Instead of you having to go and pick those underlying components, let's use a top 40. I think to buy the top 40, you currently need about, 500, 600,000 Rand and then you can buy the top 40 and its constitutes for a client, or you can buy a top 40 ETF where all of that. But that top 40 ETF, while it doesn't seem that way, is as liquid as the underlying top 40. So that's the one passing thought for me. Before I thank my colleagues, I don't know if I'm going to ask if there's any immediate questions for either Deborah or Nerina.
I just want to find out about tax efficiency when you select the ETFs from the platform, especially when you select them from the, not direct, but from the unit trust platform, like Stanley platform. You go there and select one of the ETFs. Are there any tax efficiency to that?
So the tax issues sit really inside the product. So if your ETF is also a CIS, a unit trust, then there's absolutely no difference in terms of the tax implications inside the ETF. Similarly, the tax implications of buying the instrument, selling the instrument would be exactly the same as it is with the CIS. There would be potentially capital gains tax implications on selling the product. But if there are any changes inside the ETF, no tax implications because it's in a CIS vehicle, so it enjoys exactly the same legislative protection that your unit trust has as well. When it's an exchange-traded note or an actively managed certificate, there could be specific tax implications in terms of that. There you are buying a security, an instrument. So I think the tax implications of those types of instruments depends a lot more on the specific investor type also. But a pure vanilla CIS-backed ETF, no different from a tax perspective than an ordinary unlisted unit trust.
Yep, thank you. I think my time has come, unfortunately. I think we can talk a lot. Thank you, Deborah. I really appreciate it. I know it's early morning in the US. I really appreciate your time to come and share your vast knowledge with us here. Nerina, thank you very much. It's always inspirational to listen to you. Up next, my colleague, Veermeyer. He's going to chat a bit about the regulatory stances and how that works, which we all have to pay a lot of attention to, otherwise none of us have got jobs. But yeah, thank you very much. Afterwards, please speak to the 1nvest people if you've got any more questions, or Nerina. Thank you very much. Appreciate it.